And here we go. Good evening, everybody. Ken Long from Tortoise Capital with a review of the weekend trading reports for March 17th, 2012. We'll just get right into it. We are in bullish, quiet conditions again. 68 out of 100 on weekly RSI 14, so we're closing in on getting into overbought conditions on the weekly RSI. That would be the final official notification that we're in a bull market using intermediate term indicators. That triggers at 70 on weekly RSI. So we're getting very close to overbought. 97 out of 100 on the 10-day NDX, so we are in overbought conditions on a short-term basis. Stretch above the 200-day moving average is at 12.25%, so that's bullish and very strong because it's coded green. The slope of the 50-day moving average is also coded green at 1.02%, so that's back into strong territory. Last week or so it had gotten just into above average. Now it's exceptionally above average, so both of those are very bullish. ADX 14 actually reversed its decline. It had gotten as high as 40 and then as low as 30, and now it's reversed and started going back up based on the strong price action this week. So that's a strong trend up. ATR percentage at 0.87% is quiet. So all of those things point to very, very strong market, as we know. The blended monthly rebalancing, 26 ETF doing well, still holding the Qs, financials, and Brazil. And the 13 ETF is holding the Qs, mid caps, and the large caps. Next reevaluation on or about 1 April. ETF 2 is still at 100% exposed, with the model at 100% exposed as well. So no change to any of that. Quick look at the blended monthly rebalancing portfolios. There we go. Sorted by the strength column, and EEM has moved ahead of the small caps, which are now ahead of SPY. So the emerging market trend is continuing to work. Latin America is still in the upper half. Treasuries have pulled back to now they're down around 111 now, almost 6% below its 4-month moving average here. So we've completely moved from a treasury base to a growth base. That's all risk on right there. And then even among the 26 ETFs now, financials, emerging markets, or emerging Europe, GUR, and the NASDAQ at the top. All of the currencies and treasuries and the agriculture and the long-term treasuries at the bottom. So it's definitely risk on and U.S. centric, and interesting to note that the financials have come all the way to the top, U.S. financials. Taking a look at the market health check. Last week, this time the market had had its little channeling dip or its overreaction dip. The channeling and overreaction both fired on that day. That's what this green symbol signals here, and it's been one uninterrupted rebound from that point. It blasted through that boundary at 137, got above 140. So the vertical blue lines are the 10, 20, and 30-day look-back time frames. The horizontal red lines are key support and resistance levels that have held before. The thin green line is the 10-day moving average. The thin red line is the 50-day moving average. The boundary between the yellow, white space and the blue space is the 200-day moving average. I like to show that as an area because it looks like being underwater. The price is below there. It feels like it's drowning. The solid black line in the middle of the channel is the 30-day regression line that's offset by 1 day. And then the outer black lines are the regression channel formed by the maximum excursion from the regression line during the look-back period, which in this case happened during the pullback about 8 days ago when it pulled back to about 135. So we have ADX, you can see, had gotten as high as 40, pulled back to 30, and now is rolling back up on the basis of the bullish conditions here. So that's very favorable for ongoing price action. You can see just how long the market has been overbought on Williams percent R during this run-up. Most of the time it's been overbought. Every little dip was an opportunity to buy more in retrospect. PPO is the percent price oscillator. It opened, the jaws opened up here again this week, and now the little Chinese dragon is pointing upward and onward with no resistance overhead when you look back 12 months. So until proven otherwise, it's definitely a bull. And what I would have to see is we'd have to see price come at least a 5% pullback. It has to get all the way back to 132 to even be something other than noise. And that would right now be a pullback that violated the 50-day moving average and the regression channel. So things look very favorable for the U.S. despite the economic reports. And then finally, the slope indicator, that represents the slope of the 30-day moving average. It's still positive, and it's starting to hook back up. You saw it was declining all the way through here because of the strength of the initial leg of this bull. That regression slope was hard to match, but it looks very favorable now. Moving onward. Quick look at the ETF2 database and the regions. The 10 regions are all on a buy signal based on the 4-month moving average, so that keeps us at 100% invested. SPY is better than EFA, so 71 is better than 65, so it still favors the U.S. right now compared to globals. And then inside the U.S. indexes, it's the NASDAQ, it's tech, mids, smalls, large. So tech at 76. Actually, I was looking at this one. 69, the mids is better than 68 in the large and the smalls. And the two strongest sectors, the Qs and MDY. Two weakest are EPP, and which is Asia less Japan, and Japan. Moving onward. Next up is the world market model. NASDAQ continues, we're looking at the U.S. first, U.S. market. NASDAQ, large cap growth, still exceptionally strong. The rest of the U.S. is above average. Latin America, emerging markets, really everything in the Western Hemisphere other than Canada is above average. Gold, silver, treasuries, corporate bonds lagging significantly. Commodities are weak. Oil has pulled back from its high price, and U.S. real estate hanging in there. The winners in Asia have the same suspects: South Korea, Taiwan, Singapore, and Hong Kong. China, Australia, and India have been the laggards all year, really for the past whole year. In Europe, seeing strength in now Sweden, Germany, and France. Looking at the business sectors in the U.S. and globally, it's still the risk-on trade, materials, energy, but especially finance and technology. Industrials doing well. All the defensive sectors are below average significantly, especially utilities. That has been that analysis has kind of been a reliable indicator of the general investing and business climate here over the last year. Moving on. Look at the ETF top 30 based on the 500 in the ETF2 database. Home construction still the number one. Regional banking, semiconductors, biotechs, U.S. technology. That's an interesting play there. Gives you the best of the U.S. and best of technology in one, and outperforming the NASDAQ slightly. Financials, XLF. I mean, it's really unusual to see one of the 9 sector spiders in the top 10, but here you have both financials and technology. So that's sort of a that's two ninths of the S&P right there. and I find that to be pretty interesting. Discretionary not far behind. So there's reason to pay attention to the XL series if you're just looking for like asset allocation. Those are an interesting way to play business sector performance. Moving on. Same ideas now looking at the Dow 30. This is sorted by just the relative strength blend now, the 3-month, 6-month. Bank of America, the top names in here are the financials. Bank of America, JP Morgan, and Caterpillar, Home Depot, Walt Disney. At the bottom of the list, HP, Johnson & Johnson, Coke, McDonald's, Procter & Gamble. And that's really kind of interesting because in the run-up of last year, those were the names that were absolutely working. That's the XLY series. Johnson & Johnson, Coke, McDonald's, Procter & Gamble, Kraft. And now we see at the top are the, basic business sectors and financials. So it's kind of interesting to see how the strength rotates through the different business sectors. Moving on. I just want to take a quick look again at market volatility. We still have it at an exceptionally low level. This is a measurement of the 30-day standard deviation of SPY as a percentage of its price. So it's at an exceptionally low level, certainly compared to the last 180 days, and then even compared to the last 5 years, it's as low as it has been in terms of percent volatility. And the volatility events happen pretty sharply. When they happen, it changes the truth pretty amazingly. But we're making hay right now while the sun is shining and conditions are good. So that's the epitome of bull quiet in terms of volatility right there. Okay, I want to shift now to the daily reports. Let me get that rascal pulled up here real quick. While we're waiting for that to come up, the girls' soccer team played an even better game in their second season, won another game by 5-0. And they were so good that I let them coach themselves make all the changes that they wanted because there was nothing I could say that would improve on their play. They were that good. So the season's really coming together well. Okay, so here we are now. Back on the daily, I'm not going to review the top row again. We'll just go right to the gap stat. And in terms of the gap down, 12 times in the last 30 days, almost still evenly split now between gap down and reverse. The gap down and reverse has happened 7 times in the last 30 days, where gap down and the reverse to close higher. The average follow through is 0.35. And then 5 times the gap down has resulted in an additional a lower close of minus 0.23%. The gap ups have happened 18 times. 7 times the gap up has reversed to close lower, and 11 times the gap up has continued to gain. So in both cases, well, actually, no, not in both cases. These are not symmetrical. Gap up and continuation is 11 out of 18, but the gap down and reverse is the majority. So once again, we can see the gap behavior is still not symmetrical. The market continues to be oversold. No signals of overreaction or channeling. The range on the pivots is still very, very tight. That's a function of the very narrow range from Friday. So it's only 75 cents between the pivot and R3 and the pivot and S3. See, volatility in the last 100 days has really come down to a flat level of below 0.9%. You can see how ADX has rebounded on the strength of last week's move. The winners, the min pain in the Dow 30 have been Bank of America, 3M, GE, Johnson & Johnson, Caterpillar. The max pain possibilities McDonald's, Hewlett Packard, United Technology, Disney, and Chevron. The 10-day max pain in the ETFs, the VIX, gold miners, silver, treasuries, and Brazil. So Brazil would be of interest to me as a trading vehicle because it has the most ground to make up, and it has been strong along with the rest of the emerging markets, even better than SPY over the last 3 months. And we've seen that developing over time. Had plenty of early warning, and that was very tradable. In terms of pattern trades, we have a ton of ETFs and large caps that are on triple screen signals right now. And we have a whole bundle that are favorable using the auto framer technique with a minimum 2-to-1 reward to risk ratio based on a retest of the 10-day high. And that's with a mechanical entry at nickel above Friday's high and with a stop a nickel below Friday's low. So the VIX, Treasury, silver, utilities, gold, Brazil, and agriculture ETF. So Brazil will definitely be on my short list. Moving on. On page 2, the Dow 30 tactical summary. Again, you can see the great big stack here of triple screens. What's interesting is Chevron is a combination of a doji and a triple screen, so that should be on the short list. And moving on to the ETF tactical. Quite a few more dojis were made on Friday, including the VIX silver and Brazil. And so I sort of like this in Brazil already because it has a 2.9 reward to risk ratio based on just a mechanical auto framer reward to risk. It's number 5 on the max pain range compression, and it has been one of the leading relative strength winners over the last couple months. So I like the fact that it's pulled back, formed a doji, and has a brilliant reward to risk ratio. The VIX still remains a favored trading vehicle of mine. It's a number 1 on the max pain range compression with a ratio of almost 8, and it formed a doji on Friday. Lisa asks, what does it mean by a breakout on an hourly basis? What that means is you can't, if you follow that rule, you have to see a price in this hour that takes out the previous hour's high. So it's almost like a universal entry, but on an hourly candle instead of a daily candle. So what could happen is it might go down for 3 hours in a row, and then the 4th candle might reverse that trend and then have a price higher than the 3rd hour's candle. So that would be the trigger to enter. And what that will do is keep you from chasing that thing too early. Then if the market's in a down day, you may not even see a higher high on an hourly basis. And so that would keep you from even entering that day. But as long as the setup conditions were the same and the red line wasn't violated, then you could still take that. You could still take that trade. Okay, moving on. If the the second question was, if the first hour in the morning is a gap up, do you have to wait 1 hour? Yes, according to that rule, you have to. That's a good thing. It keeps you from chasing. There's also if you use that auto framer technique, you also know that, and if you're using the 2-to-1 reward to risk ratio on a retest of the 10-day high, that still tells you what the maximum price you can pay and still have 2-to-1 reward to risk. So, know your decision frame is what I would say. Okay, moving on. We're taking a look at the charts, the Mosaic charts now. Regression line continues to be very strong. The regression line reversed and has crossed back over its 10-period moving average. That's very favorable. So it had pulled back from a +1 standard deviation to about a half and is now finding support. And You can see on the percent stretch relative to the 200-day moving average, we've got a 2 standard deviation up move from the average, so very, very favorable. Everything looks good, no resistance overhead, and you know, it's bull quiet and all systems go, you know, for the foreseeable future until there's more than a 10% pullback. That's what it would take to start getting us out of this bull quiet. Moving on. Lots of frog candidates that are better than 3.0. There we go. Everything from Caterpillar and above, so almost 1/3 of the stack here is above the critical 3.0. Boeing, coal, consumer discretionary, all of those look good. Mid caps look good too at 3.2. And with a 60-cent standard deviation. Okay, moving on. Let's see. Actually, that's really all I really want to talk about on the charts of interest right now. It's the high relative strength, and I guess let me come back to just one more chart. We'll take a look at the holding X-day periods to see if there's anything to be seen on here. The only thing that would concern me here is if the you know, we're getting close to overbought on weekly RSI because we're at 68 out of 100. At 70 is the trigger to make that overbought on a long-term basis. And so now what I'm going to just look for, see if there's anything that has stretched beyond its normal parameters in terms of gains over the last X number of days. So looking at a 40-day period, the market's Z-score is only 0.73. On a 20-day, it's 0.50. 10-day 0.66, and on 5 days at 0.70. So really nothing drastically overheated. Technology is the strongest index that we've seen, and even the Qs on a 40-day basis only at 1.02 Z-score, 0.64 for 20, 0.71 and 0.64 for 10 and 5 days. So I mean, all of those, there's nothing really that's run away from its historical parameters. That pullback of about 6 or 7 days ago blew some of the steam off, and that was responded to with immediate resumption of buying. And so this is not an overheated market. Brad has asked me, can I talk about a good way to approach beginning to build a portfolio from a cash position from all the buys? How would I weight them? Well, typically I think about that when the world market model is somewhere around, you know, like at 0%, and so I'm all cash. It starts signaling relatively early when to get back in. So it takes about, after a significant sell-off, it takes about 3 weeks for that to turn and start flashing buy signals. And typically I go into those in, you know, 20% increments. Normally when I think about an intermediate asset allocation model like ETF2 or something, I usually recommend phasing that in to go from cash to a full equity position over the course of 4 weeks, so like 4 increments of 25%. And what I would do on that is take like the top, if it was flashing 8 buy signals or 10 buy signals like it is now, I would buy maybe 2 or 3 of the percent leaders, 2 or 3 more the next week, and then over the course of 4 weeks I would have averaged in. What that does is that after a long period of bull quiet like this one, keeps you from chasing, and it's an incremental approach to gathering a position. Otherwise, you're kind of at the mercy of the random entry that you end up actually choosing. So, you know, the more detailed answer would obviously be based on your total equity position and what percentage of the portfolio we're talking about, financial objectives and all that. But I just find at some point you got to hold your nose and buy, because If you're on the sidelines, the market keeps going up, there's always going to be a feeling that, well, it's just waiting for me to put my money in order to reverse. And so that's a reason to never get in. So at some point you got to hold your nose and go. My judgment right now on this one is that on between a 5 and a 40-day holding period, it's not overextended at all, and there's no resistance overhead. So I mean, it's a bull quiet market, and the U.S. is better than the world. Financials, technology, and small caps, and go. XLK, XLF, IWM, and buy the positions and go. So, okay, well, University of Kansas is getting ready to play here, and I've got a webinar I got to run for my college class. They're in their last week of the semester, and they're all suffering from the evil Dr. Long, and I got to get ready for that. So I'll go ahead and close off the webinar here. I will put this recording on YouTube here in a couple hours. It'll be processing in the background, and I'll send the link out to that video. Oh, Brad asked me, can I state again what to base the entry and stop on? A nickel above yesterday's high, a nickel below yesterday's low, and it's based on if that represents 1R risk, or range risk, what I would call one range risk, then the reward is based on a retest of the 10-day high. Okay. So thanks for your attention, everybody. I'm going to go ahead and sign off here, and we'll see you in the chat room. I'll be in Raleigh. I think I'm taking off Thursday, and then it's the Friday, Saturday, Sunday for mechanical systems, and then next week will be live trading week out at in Raleigh. So we should have a lot of activity in the chat room. So take good care.